So, if you were to ask 100 tech investors right now to name the companies building the physical framework of the AI revolution, you would probably hear the exact same names on an endless loop.
Oh, absolutely. You'd get, NVIDIA, AMD,
Raycom,
right, Astro Labs, just the usual suspects.
Exactly. But you probably wouldn't hear the name of the company that just quietly swallowed $5 billion in AI infrastructure orders.
Yeah, totally shattering their own yearly guidance in just a single quarter.
Right. You probably wouldn't think of like the dusty router sitting in the dark corner of your office's IT closet, which is exactly why we're doing this deep dive today.
It is the ultimate legacy blind spot for the market right now.
It really is. The prevailing narrative on Wall Street is that legacy hardware giants are just, moving way too slowly to capture the generational wealth being generated by these large language models.
Because the assumption is that pure play AI hardware companies are basically eating the world, right?
Right, while the old guard just sort of fades into utility status. But we are looking at data today from Cisco's Q3 2026 earnings call that completely fractures that assumption.
It really does.
So if you were an investor trying to figure out where the capital expenditure cycle is moving next, or if you're just, trying to understand the physical reality of how these multi-billion parameter models are actually trained and deployed.
Because it takes actual physical hardware.
Yes. The numbers in this transcript are going to fundamentally alter your thesis.
And I think the broader context here is critical. We are sitting in a 2026 market where literally every single corporate earnings call features the word AI shoehorned in 50 times.
Well, at least 50, just to appease the algorithms and the retail traders.
Exactly. So the critical filter we have to apply for you today is figuring out who is actually monetizing this hypergrowth.
Right, versus who is just slapping an AI label on standard enterprise software.
Right. And Cisco's data provides a very clear, mathematically undeniable answer to that question.
So let's get straight into the core data from Q3. Cisco delivered record total revenue of $15.8 billion.
Which is up 12% year over year.
Right. And non-GAAP earnings per share came in at $1.06, so up 10%.
Yep.
But the real story, the metric that dictates the entire trajectory of this business, is the spread between recognized revenue and product orders.
That spread is the whole ball game.
It really is. So recognized revenue is up 12%, but total product orders grew by an unbelievable 35% year over year.
Yeah, we have to unpack that because recognized revenue is basically backward looking.
Right. Explain that for people who might not be deep into the accounting side.
Sure. So the $15.8 billion sitting on the income statement, that's because the hardware was already shipped, racked, and turned on. It's done.
Right.
But a 35% surge in product orders, that is a massive leading indicator.
Because that's contract volume.
Exactly. It represents customers actively locking in future capital expenditures today because, frankly, they are anticipating severe capacity constraints tomorrow.
Okay, wait, hold on. I have to attack the premise of that 12% top line number for a second.
Go for it.
Because we are watching pure play AI hardware companies post, 150%, 200% year over year growth right now.
Oh, easily, yeah.
So for anyone holding Cisco stock, 12% feels like they are still crawling while the rest of the industry is sprinting.
I hear that.
I mean, in the context of an AI supercycle, isn't 12% actually incredibly sluggish?
Well, it's easy to look at a pure play AI company doubling its revenue and compare it to Cisco, but you are completely ignoring the physics of scale here.
Okay, what do you mean?
We have to respect the law of large numbers. Cisco is not some hyper-growth startup. It is a massive multinational leviathan.
Right, they've been around forever.
Exactly. So moving a ship this large by 12% on the top line, that equates to billions of dollars of net new organic growth.
That's a good point. 12% of a massive number is still a massive number.
Right. To generate nearly $16 billion in a single quarter and still accelerate in double digits requires just flawless execution.
Okay, but to validate my skepticism, we really have to look at the internal mix of that 12%. Where is the growth actually coming from?
Exactly. And when you strip out the legacy maintenance contracts and you isolate just their product revenue.
Like the actual physical stuff?
Right. The silicon, the switches, the core software moving out the door. That specific segment actually grew by 17%.
Oh, wow. Okay, so higher than the headline number.
Much higher. And if you drill down even further into just the networking division, you see a 25% acceleration.
Okay, so the core engine, the part of the business structurally leveraged to the AI build-out, is moving much, much faster than the 12% consolidated number implies.
Exactly. You have to look under the hood.
And we can't ignore the software transition that is happening underneath all these hardware sales either.
The subscription numbers were huge.
Total subscription revenue hit $7.8 billion this quarter. That is 49% of their total revenue.
Which is wild to think about for a hardware company.
Right. Nearly half of Cisco's revenue is now completely untethered from physical boxes and tied to recurring subscriptions.
And that completely changes the valuation multiple Wall Street is willing to assign to them.
How so?
Well, hardware revenues are inherently cyclical. They boom and bust with upgrade cycles, right?
Yeah, people buy a bunch of routers and then don't buy them again for 5 years.
Exactly. But software revenues are sticky. Management specifically highlighted their RPO remaining performance obligations,
which hit $43.5 billion, up 4%.
Right.
The RPO dynamic is always fascinating to me because it's effectively the shadow balance sheet.
It really is. It's essentially the sum of deferred revenue and the value of non-cancelable contracts that just hasn't been invoiced yet.
So having $43.5 billion locked in the RPO means that if, the global economy completely seized up tomorrow,
and 0 new purchase orders came in.
Right. 0 new orders. Cisco still has a multi-year, multi-billion-dollar revenue waterfall that is contractually guaranteed to hit their income statement.
Which provides absolute downside protection while the hardware business gets to chase the upside of the AI boom.
Which is a beautiful place to be.
It's the best of both worlds.
Okay, so that brings us to the massive tectonic shift driving that 35% spike in orders. We have to talk about the apex predators of the tech ecosystem.
The hyperscalers.
The hyperscalers. And the data here is just staggering.
It really is.
Product orders from service providers and cloud customers grew 105% year over year.
Wait, let me just reiterate that. 105%.
Right. And 5 of Cisco's top hyperscaler customers grew their orders in the triple digits.
The acceleration curve here is what caught the analysts completely off guard on the call.
Oh, the upward revisions were easily the single most shocking data point of the entire transcript.
Yeah, walk us through that timeline because it's crazy.
Okay, listen to this. Cisco took $1.9 billion in AI infrastructure orders from hyperscalers just in Q3 alone.
Just one quarter.
Right. A year prior, that number was $600 million.
Which is a massive jump.
But it gets crazier. Year to date, they have hit $5.3 billion.
Okay, and for context, what was their original goal?
Right. So at the beginning of the year, Cisco modeled out their internal forecasts and told Wall Street they expected to take about $5 billion in AI infrastructure orders for the entirety of fiscal year 2026.
And they shattered that 12-month forecast in 9 months.
Exactly. And because of that demand, they completely revised their FY26 expectation to $9 billion.
$9 billion.
That is 4.5 times their total from fiscal year 2025.
I mean, you do not revise your guidance upward by $4 billion mid-year unless the purchase orders sitting on the CFO's desk are completely ironclad.
Right. This isn't some speculative pipeline.
No, this is contracted demand. And the real question investors should be asking right now is, why Cisco?
Exactly. Why are the most sophisticated cloud providers in the world, companies that literally have the engineering talent to build their own white box switches, why are they suddenly buying proprietary Cisco gear at this velocity?
It all comes down to Silicon One.
Yes.
If we look at the history of tech hardware, the companies that control the underlying silicon inevitably control the margin and the performance.
It's like Apple moving away from Intel to their proprietary M-series chips.
That is the perfect analogy. By designing the silicon specifically for their own operating system, Apple totally bypassed the thermal and performance bottlenecks of generic chips.
And Cisco is doing the exact same thing, but in the data center.
Right. They aren't just slapping third-party merchant silicon into their switches anymore. Silicon One is custom-built ASICs, designed exclusively to route AI workloads.
And the architectural advantage of Silicon One becomes highly apparent when you look at the specific design wins Chuck Robbins outlined in the Q&A.
Yeah, he spent a significant amount of time detailing their victories in scale-across deployments versus scale-out deployments.
Okay, so we need to translate this because this is where the actual physics of AI training comes into play.
Right, that gets a little nerdy here.
Let's do it. So if we are looking at a massive data center filled with, tens of thousands of GPUs, scale-out is essentially the local neighborhood.
Right, it's the network architecture connecting a highly concentrated cluster of servers in one building so they can share memory and compute power for a specific training run.
And Cisco has been dominating that space with their G200 chips.
But scale out is just a localized problem. Scale across is the holy grail of networking right now.
Because we are reaching the physical limits of how much power and cooling you can shove into a single data center footprint.
Exactly. You literally cannot get enough electricity to one building anymore.
So hyperscalers are now being forced to build massive AI clusters distributed across multiple different geographical locations.
Right. And scale across is the network fabric required to connect those disparate data centers over hundreds of miles, so they function as one unified, logical supercomputer.
And the engineering difficulty of that is astronomical.
Oh, is insane.
Like when you are training a model across multiple data centers, the latency requirements are microscopic.
Yeah, if one packet of data gets dropped or delayed by just a few milliseconds over a 300-mile fiber optic link,
the entire GPU cluster has to sit idle waiting for that data to synchronize.
Which means you are burning thousands of dollars a minute in stranded compute.
Right. So flawless packet routing over long distances is arguably the hardest problem in distributed AI right now.
Exactly. And Robbins announced on the call that Cisco secured 3 major scale-across design wins with hyperscalers using their new Silicon One P200 system.
3 of the biggest cloud providers on Earth.
Right. Locking them in for the most complex networking challenge in existence proves that Silicon One isn't just a cost-saving measure.
It's the performance bottleneck breaker.
Exactly.
But it doesn't stop at the silicon layer, does it? Because the data still has to physically move between these switches.
Right. You need the actual pipes.
Which brings us to the Acacia Optics business.
Oh, man. The Acacia numbers.
The numbers here are just wild. Over $1 billion in Q3 orders, tracking for 200% year-over-year growth.
Unbelievable.
They shipped 750,000 units of 400G and 40,000 units of 800G coherent pluggable optics.
We really need to talk about the mechanics of this because coherent optics is one of those terms analysts throw around on CNBC without actually understanding the underlying mechanism.
Let's break it down. It really is the unsung hero of the AI build-out.
So the Silicon One chip does the routing logic, right? It's the brain.
Right.
But the connection between the switches is fundamentally optical. It's literally light traveling through glass.
Okay.
Traditional fiber optics work essentially like high-speed Morse code. You flash a laser on and off to represent ones and zeros.
So it's binary, on, off, on, off.
Exactly. That is binary, non-coherent transmission.
Yeah.
But when you need to push 800 gigabits per second down a single microscopic strand of fiber, the Morse code approach hits a hard physical limit.
Right, because you can only turn a laser on and off so fast before the signal just degrades into noise.
Exactly. It just becomes a blur.
So Acacia's coherent technology basically bypasses that limit by manipulating the actual physical properties of the light wave itself.
Yes, the phase and the amplitude.
Right, so instead of just on or off, they are utilizing these advanced modulation techniques like QAM, quadrature amplitude modulation, to encode multiple bits of data into a single symbol.
Which essentially means they're packing massively more data into the exact same beam of light.
It's basically magic.
It is. And because the digital signal processors required to execute that phase modulation are so incredibly complex to manufacture at scale, Cisco essentially operates in a league of its own here.
Yeah, management explicitly noted that their shipments of these high-speed coherent optics far exceed their next largest supplier.
They are miles ahead.
So if we synthesize this hyperscaly dynamic for you, Cisco is selling the proprietary routing brains with Silicon One and the proprietary optical nervous system with Acacia to the companies building the multi-trillion-dollar foundation of the next decade of compute.
It's a massive competitive moat.
But as compelling as the cloud infrastructure story is, relying exclusively on a handful of hyperscalers is structurally risky. Oh, for sure. You don't want your entire business dependent on 5 customers.
Exactly. You want to see broad-based, macro-level demand.
Which requires us to look past those apex predators and examine the Fortune 500.
And the enterprise data on this call was equally telling. Let me read you these numbers.
Hit me.
Enterprise product orders were up 18%.
Okay.
Public sector orders were up 27%.
Nice.
But the most aggressive signal was enterprise data center switching, which grew over 40%.
That 40% number is absolutely critical.
Because these aren't hyperscalers building massive training clusters.
Right. These are banks, healthcare networks, logistics companies. They are actively ripping out and replacing their core infrastructure.
And what's driving that? Because replacing a core network is a massive headache. You don't do it unless you have to.
The causality behind that 40% growth is directly tied to the deployment phase of AI.
Okay, unpack that.
So the hyperscalers are building the infrastructure to train the models, right?
Right. But the enterprise businesses are upgrading their networks to infer and deploy those models internally.
Oh, okay.
Cisco cited internal research on the call showing that 93% of IT leaders are actively accelerating their network modernization plans right now.
93%. That's basically everyone.
Exactly. Because the expectation is that AI-driven applications, internal intelligent agents, and automated data processing will literally 3x total network traffic over the next 36 months.
Wow. If the traffic in your internal corporate network triples in 3 years, your legacy Ethernet and Wi-Fi architectures will simply collapse under the density.
They will melt, which is exactly why we saw Cisco report double-digit sequential growth in Wi-Fi 7 products.
Which, according to the transcript, now make up half of their entire wireless mix.
Right. They're literally overhauling the airwaves of the enterprise to support these high-density AI endpoints.
But, and this is where the transcript gets incredibly tense, the analyst community is hyper-vigilant right now about this exact narrative.
Oh yeah, they are not just taking management's word for it.
Not at all. During the Q&A, Tal Liani from BofA Securities pressed management on a highly skeptical but entirely necessary theory regarding pull-forward demand.
The pull-forward debate. This is the shadow hanging over every hardware manufacturer right now.
It really is. Tal essentially looked at the 19% growth in non-AI orders and questioned its authenticity.
Because the broader macroeconomic environment for enterprise IT spending is still highly constrained, right? Capital's, it's expensive.
Exactly. So Tal's question was, is this 19% organic growth driven by genuine necessity, or are procurement officers just panicking?
Panicking about the supply chain constraints caused by the hyperscalers.
Right. Are they looking at NVIDIA and Broadcom and saying, we need to pull our 2027 orders into 2026 just to guarantee we secure a place in the manufacturing queue?
And that is the ultimate trap for a hardware company.
Why?
Well, if the growth is just pull-forward hoarding, Cisco is effectively cannibalizing their future revenue.
They're just moving money from next year to this year.
Exactly. We saw this exact phenomenon play out during the dot-com crash in 2001. Cisco had to write off billions in excess inventory because customers had double and triple ordered just to secure supply.
Oh, right. And we saw a micro version of it again in 2021 during the pandemic supply chain hangover.
Right. So Liani is asking if history is repeating itself right now.
And Cisco CFO Mark Patterson, he didn't deflect at all.
No, he came prepared.
He delivered a highly technical 3-point defense to isolate exactly where that 19% came from.
Let's go through his points.
Starting with pricing power. Patterson clarified that out of the 19% growth in non-AI orders, 4 to 5 percentage points were strictly the result of strategic price increases.
Okay, which completely neutralizes a quarter of the pull forward argument right there.
Exactly.
That 4 to 5% isn't an increase in physical units being hoarded. It is just the mathematical reality of Cisco passing inflationary costs onto the customer.
And the customer actually absorbing it without churning.
Right. It's high margin price realization.
Okay. His second point addressed pipeline velocity. Management has really deep visibility into the expected close dates for major enterprise deals.
Sure.
And Patterson stated that when they looked at deals originally slated for Q4 that were abruptly pulled forward and closed in Q3, the volume was well within historical normalized ranges.
So there was no statistically significant panic buying anomaly in the data.
Exactly. But the third point is what I call the definitive kill shot to the pull forward thesis.
What was it?
If customers were exhausting their budgets to hoard equipment in Q3, the forward-looking pipeline for Q4 would logically be highly degraded.
Right, because the money is spent.
Right. But Patterson explicitly noted that from week 1 to week 13 of the quarter, the Q4 pipeline did not degrade. It actually expanded.
Okay, that's huge. That means the organic demand is compounding, not cannibalizing itself.
Exactly. But Patterson's admission that 4 to 5 points of growth came from price increases forces us to look under the hood at the operational realities of building all this equipment.
Right, because you don't aggressively hike prices unless your underlying cost of goods sold is under severe pressure.
Exactly. And that brings us to the margin squeeze.
Yes. The margin numbers.
Cisco reported that their non-GAAP product gross margin fell 330 basis points to 64.3%.
Which, for a company that prides itself on operational leverage like Cisco, a 3.3% hit to product gross margins is a heavy bleed.
It really is. So if they're selling record amounts of hardware, why are their product margins shrinking?
The margin degradation is basically the consequence of two massive headwinds converging simultaneously. You have a product mix issue, and you have global memory pricing.
Let's start with the mix issue.
The mix issue is straightforward. As we discussed earlier, software and services carry inherently higher margins than heavy metal hardware.
Right.
Because the AI infrastructure boom is driving hardware sales at an unprecedented rate, hardware is making up a disproportionately large percentage of the total revenue pie.
So it inherently drags the blended gross margin down.
Exactly, it's just math.
But the memory pricing issue is the real macro variable here.
Oh, absolutely.
Because the sheer volume of high bandwidth memory, or HBM, required to feed these AI GPUs has effectively cornered the global memory market.
Completely cornered it. Foundries are dedicating all their capacity to HBM right now.
Which has caused the price of standard DRAM and the memory components used in regular networking switches to basically skyrocket.
Right. And Cisco has to absorb those spot market price hikes to actually build their gear.
Which is why Patterson immediately outlined a massive engineering counteroffensive on the call.
Yes, I love this part. They aren't just taking the commodity pricing hits passively.
Not at all. Cisco currently has over 20 active cross-functional engineering programs entirely dedicated to reducing memory utilization at the architectural level.
It is such a fascinating flex of R&D capability.
It really is. They are literally redesigning the hardware to simply require less of the expensive commodity.
Right. Patterson noted that their upcoming wireless product iterations have been re-engineered to require 50% less memory than the current generation.
50% less. That's massive.
And at the same time, they are aggressively transitioning their core portfolio from DDR4 to DDR5.
Which provides a much more efficient power and bandwidth profile, right?
Exactly. It allows them to consolidate the overall bill of materials.
And that kind of architectural agility is only possible because they maintain absolute control over their supply chain.
Right, because they design Silicon One in-house, they aren't relying on merchant silicon vendors to dictate their hardware roadmap.
They interface directly with the semiconductor foundries managing the wafers and substrates.
And management announced they have secured guaranteed silicon supply through the entirety of calendar year 2026.
Yeah, and they threw their massive balance sheet at the problem to ensure it.
Oh, they threw a lot of cash at it.
They increased their advanced purchase commitments by $6.7 billion in just a 90-day window.
Almost $7 billion.
They are literally walking into the supply chain, dropping nearly $7 billion in upfront cash, and locking out their competitors from securing manufacturing capacity.
That is the brute force advantage of being a legacy giant. A startup simply cannot do that.
No way. However, we have to remain objective here and address the glaring weakness in this quarter's transcript.
Yeah, we have to talk about the thorn in their side.
Right. While the hardware and supply chain execution was basically flawless, the security and software portfolio was totally stagnant.
Security revenue reported flat year-over-year growth. 0%.
And in an environment where enterprise cybersecurity is literally a top 3 board-level priority for every company on Earth.
Flat growth is a massive red flag on the surface.
It looks terrible. How do you post 0% growth in security right now?
Well, it requires a really deep dive into the accounting mechanics of the Splunk acquisition.
Okay, unpack that, because it seems like more than just a bad sales quarter.
It is. The stagnation is less about product failure and entirely about a deliberate, painful transition in SaaS revenue recognition.
Explain the accounting there.
So when Cisco acquired Splunk, a significant portion of Splunk's legacy customer base was operating on on-premise upfront software licenses.
Like I pay $1 million today for a 3-year license.
Exactly. And under that model, the vendor gets to recognize a massive chunk of that $1 million immediately, right in the current quarter.
Which makes the quarter look great.
Right. But Wall Street hates lumpy, unpredictable revenue. They want ratable, highly predictable annual recurring revenue, ARR.
Right.
So Cisco is actively forcing these legacy Splunk customers to transition away from upfront licenses to cloud-based subscriptions.
Which sounds good for the long term.
It is. But the problem with that transition is the immediate accounting valley of death.
Valley of death.
Yeah. When you move a customer to a subscription, you can only recognize the revenue ratably over the life of the contract.
Oh, okay. So instead of recognizing $1 million today,
you recognize $30,000 a month.
Wow. Okay, that hurts the current quarter.
Right. The actual cash flow over the lifetime of the customer increases. But the immediate near-term recognized revenue just plummets.
And that accounting drag is what made the entire security division look flat this quarter.
Exactly. It's the classic SaaS transition pain point. You sacrifice the current quarter to build a predictable cash flow engine for the next decade.
Got it. And strategically, they are trying to integrate AI into the core of their security offerings to accelerate that cloud adoption, right?
Yes. They highlighted over 5,000 net new customers for their new AI-driven security products.
Which is absolutely critical because the threat vectors have completely changed.
Oh, completely.
Threat actors are utilizing generative AI to automate the discovery of zero-day vulnerabilities and execute highly sophisticated phishing campaigns at incredible scale.
You literally cannot defend against AI-driven attacks with static rule-based firewalls anymore.
Right. You need AI-native defense mechanisms that can analyze anomalous behavioral patterns in real time.
And Cisco is building the infrastructure for exactly that. Did you catch the Defense Claw mention?
Yes. They launched Defense Claw, which is an open source solution specifically designed to help enterprises safely deploy and monitor autonomous AI agents within their networks.
That's a huge step.
Furthermore, they are a founding partner in Project Glasswing.
Right, with Anthropic.
Exactly.
Okay.
Where they are actively collaborating with Anthropic to test the new Mythos AI model strictly for proactive cyber defense applications.
They are essentially attempting to position the network itself as the ultimate AI bodyguard.
It's a great concept, but all of this brings us to the most paradoxical moment of the entire earnings call.
Okay, yeah. Let's talk about the restructuring.
We have spent this entire deep dive outlining historic order growth, $9 billion in AI infrastructure demand, massive enterprise network overhauls, ironclad supply chain execution.
Everything is going great.
Right. And what is management's strategic response to this overwhelming success?
They announced a $1 billion pre-tax restructuring charge.
When I read that, it felt completely incongruous. A $1 billion restructuring charge with $450 million of it hitting immediately in Q4.
Yeah, it raises a lot of eyebrows.
Because traditionally, when a legacy tech company announces a massive restructuring, it is Wall Street code for our core business is decaying, we are bleeding margin, and we need to execute mass layoffs to protect our EPS.
Right.
So my pushback is, why on earth are they taking a $1 billion charge during the strongest demand cycle in their history? If they're having their strongest year ever, why are they spending $1 billion on restructuring?
A fair question, and CFO Mark Patterson was highly protective of the narrative surrounding this charge on the call.
What was his defense?
He was adamant that this is not a defensive, cost-cutting measure designed to shrink the company into profitability.
Okay.
This is a hyper-aggressive reallocation of capital and talent.
So it's a tactical redeployment.
Exactly. The AI infrastructure market is moving at a velocity that basically defies traditional enterprise planning cycles.
Right.
If Cisco waits for natural attrition to shift their headcount from legacy, slow-growth divisions into their high-growth AI sectors, they will completely lose their window of opportunity.
So they are utilizing this $1 billion charge to forcefully pivot their engineering talent, their real estate footprint, and their R&D capital directly into Silicon One, Acacia Optics, and AI-native security.
Yes. They are clearing the decks to double down on their winners because the market is just moving incredibly fast.
And that pivot isn't just external. The transcript reveals they are entirely overhauling their internal operations with AI as well.
Yeah, the Circuit adoption numbers were really interesting.
Chuck Robbins specifically highlighted the adoption of Circuit, which is Cisco's proprietary, internally developed AI assistant.
And this isn't just a basic chatbot API plugged into their intranet.
No, they reported 8 million quarterly interactions with Circuit across their employee base.
That internal adoption rate is a massive signal of operational leverage.
How so?
Well, when a company with the headcount of Cisco integrates a proprietary AI tool to that degree, they are fundamentally altering their internal cost structure.
Right.
If those 8 million interactions are automating code generation or streamlining supply chain logistics or accelerating customer support resolutions,
the compounding efficiency gains will eventually manifest as significant operating margin expansion.
Exactly. They are utilizing the exact same AI architectures they are selling to the hyperscalers to run their own business.
So synthesizing all of this, the hypergrowth, the supply chain mastery, the software transitions, and this massive restructuring, What is the actual forward-looking reality?
Right, let's get to the guidance.
Management laid out their guidance, and the expectations dictate a profound level of confidence. For Q4, they are guiding revenue between $16.7 billion and $16.9 billion.
Huge numbers.
And for the full fiscal year 2026, they are modeling a massive $62.8 billion to $63.0 billion top line, with an EPS of $4.27 to $4.29.
Those projections definitely represent a company operating at peak execution.
They really do. But as analysts, our job isn't to just repeat the guidance, right?
No, we have to break down the risk-reward matrix for you, the listener.
Exactly. Based on the totality of the data we've unpacked today, we have to isolate the fundamental bullish and bearish cases for your portfolio.
Let's construct the bearish argument first.
Okay, if you are deeply skeptical of this legacy giant, what are the primary friction points in this transcript that should keep you up at night?
The bearish thesis essentially hinges on execution risk within the software transition and macro-level commodity constraints.
Right.
The Splunk integration and the aggressive shift toward ratable cloud-based security subscriptions will mathematically continue to suppress recognized revenue growth in the near term.
And Wall Street demands immediate gratification.
Exactly. If the ARR doesn't compound fast enough to offset the loss of those big upfront licenses, the stock will absolutely get punished.
And what about the hardware side for the bears?
For the hardware side, the memory cost headwind is entirely outside of Cisco's control.
Because of the HBM demand from AI GPUs.
Right. They are executing brilliant engineering workarounds to reduce memory utilization. But if the AI arms race continues to squeeze global DRAM supply,
the relentless pressure on their gross margins will eventually erode their earnings power.
Exactly. So the bears are watching the software accounting drag and the spot price of high bandwidth memory very closely.
Okay, but on the flip side, the bullish signal coming out of this transcript is almost deafening.
It really is.
The narrative that legacy infrastructure companies are obsolete in the AI era is fundamentally shattered by these numbers.
Completely shattered.
I mean, they quadrupled their AI infrastructure orders in a single year. They have locked in $4 billion in incremental contracted AI revenue for FY26.
They're expanding enterprise data center switching by 40%.
And they possess an unassailable strategic moat in the form of proprietary Silicon One ASICs and Acacia coherent optics.
Backed by a supply chain that has pre-purchased $6.7 billion in capacity to lock out competitors.
Right. The bullish conclusion here is that Cisco has successfully positioned itself not merely as a participant in the AI supercycle, but as the actual foundational plumbing required for the hyperscalers to deploy these multi-billion parameter models across distributed geographic footprints.
It's a highly compelling narrative.
All right, before we close this out, I want to leave you with one final, deeply provocative insight buried at the very end of Chuck Robbins' prepared remarks.
Oh, this is the best part.
We spend so much time analyzing these transcripts because the most disruptive technologies are often mentioned casually, almost as an afterthought, before the mainstream financial press even knows how to price them.
You're talking about the quantum networking prototype.
Exactly. Deep in the call, Robbins announced that Cisco just introduced a fully functional working prototype of the Cisco Universal Quantum Switch.
Which just sounds like sci-fi.
It really does. This is a piece of hardware designed to route and preserve entangled quantum information between disparate systems at room temperature over standard telecom fiber optic infrastructure.
The implications of room temperature quantum routing over legacy fiber are just staggering.
Why?
Because the entire bottleneck of quantum computing right now is the inability to network quantum processors together without massive cryogenic cooling infrastructure.
Right. They have to be kept at almost absolute zero.
Exactly.
So I want you to mull this over. The entire market right now is having a collective panic attack over generative AI, right?
Yeah.
Fighting tooth and nail over GPUs, HBM memory, and scale across networking architectures.
Yep.
But if Cisco is quietly in the background today, demonstrating working hardware to route the quantum internet of the future.
Is this massive $9 billion AI infrastructure win just a stepping stone?
Exactly. Are we looking at a company that isn't just surviving the current AI supercycle, but is already laying the physical foundation for a paradigm shift that makes large language models look like a pocket calculator?
It really suggests a level of forward-looking R&D that Wall Street is entirely failing to price into the current valuation.
The router in the closet isn't just getting an AI upgrade. It is preparing for quantum mechanics.
The ultimate legacy blind spot.
It really is. Thank you so much for joining us on this deep dive. As always, we encourage you to look past the superficial headlines, scrutinize the underlying numbers, and stay insanely curious about the mechanics of the future. We will catch you on the next deep dive.